Well, hello, this is Jim Musgrave with Research Financial Strategies, and thank you for watching my first quarter 2016 market review video. The purpose of these quarterly videos is to keep you up to date with the ever-changing markets and provide insight on how to best grow and preserve your money. I'm going to try to keep this video to no more than 10 or 15 minutes. We'll try to keep it really short and to the point. So we start off with the S&P 500. Yes, the market is up over 200% since its recession lows in March 9th, 2009, but you can see in the last 7 months, last August and January of this year, we've had significant pullbacks and volatility in the market. And you can see here on this volatility slide, these huge pullbacks. Now, the reason for these pullbacks, the one recently in January, was obviously the continual drop in oil prices. Oil's really been has gotten hit over the last 2 or 3 years. That's had major economic ripple effects throughout the global economy. That's really kind of hurt performance worldwide. We've also had fears in China of this China slowdown. And also there's been fears of the U.S. going into recession. As a matter of fact, the most recent Fed minutes, Janet Yellen and the rest of the board members have decided not to raise interest rates in the near future just because of the global landscape is very fragile at this point, and they don't want to increase fear and volatile markets by raising interest rates too fast. So I think that's a good move for the Fed. Now, when you have these drops of 12% and 13%, that doesn't mean you can't make money. And so what I have here is a sort of a breakdown of some of the sectors that have made money. And obviously, when things go south, gold tends to be a defensive position. So you can see that gold is up nearly 16% year to date, but what's even more astonishing is that the actual gold miners themselves are up nearly 46-47% just year to date in the first quarter. Those are astonishing numbers. So again, gold has certainly been a good sector to own in times of fear. Now, when when things start going south, other defensive sectors are utilities. Utilities are up over 12% year to date, and obviously the 20-year Treasury notes again the Treasury bonds are a good safe haven, so we're up nearly 10% year to date, and the 10-year Treasury. One surprising sector that has done well is emerging markets. I mean, you can see in the last 3 to 5 years it's really gotten beaten up, but you can see year to date it's up almost 3%. So that was sort of a surprise sector in the first quarter, and you can contrast that against international stocks, which are down roughly 6%, a little less than 6% year to date with the international. That would be your iFund and your TSP if you're keeping track at home. The bond markets as a whole are doing pretty well. They're up roughly 2.5%. And the Dow Jones Industrial Average is up about 1%. You have the S&P 500 at pretty much break even at 6 basis points. The NASDAQ is still trying to gain ground. It's down negative 2.66%. And small cap is a little further behind at negative 3.27%. And so those are the main sectors. So again, when you have this major market volatility, you can make money. And what this shows you is how important it is to be tactical and own the sectors that are very positive and not own the ones that are going to drag down your portfolio. So again, you're probably a client of mine, or if you're not a client of mine, I use a very tactical approach to money management. And we also have a sell-side discipline. So when sectors fall out of favor, we would rather take a small loss than a large loss. And so that's a little bit of a summary of the overall some of the sectors that are going on. So I'm going to go back to the guide to the markets. And I want to show you one more thing. So let's kind of talk about, I kind of mentioned there's some fears of recession. So let's kind of put the recession in perspective here. This is a great slide, by the way. You can see that this little blip right here, this is the market volatility that we've had in the last 7 months or so, but is nothing compared to the last 2 recessions that we had. This red horizontal line is the 20% market decline, and we are nowhere near that right now. But just to give you a little bit of history of bear markets, again, I've talked about this over and over, but I can't emphasize this enough. What we see right here is 10 significant recessions. And the average duration of a recession is 54 months. And you can see, with the exception of this bull market just before the tech bubble bursted, so we had 115 months of a bull market before the tech crash. That was it was a very, very long period of a bull market. The bull market that we're in right now, we've been going on for 86 months, which is about 32 months past the average. So what this tells me is that it's just a matter of time before the next bear market hits. Not to get political, Donald Trump mentioned that we may be in for a recession. Well, I may not agree with his politics, but his statement may be correct, and is that I do see a recession down the road. I don't think it's going to happen anytime real soon, but I definitely think it's something that you need to prepare for. Again, what are you going to do when markets drop? And I'm going to show you another slide that Jeffrey Gunlock from Double Line showed that kind of gives you some indicators of the recessions coming up. So you can see right here that this is the S&P net profit margin. And you can see when the S&P profit margin drops 60 basis points or more, that's typically an indication of a recession. And so 1985 was the only period when a 60 basis point decline in profit margins did not coincide with or predict a recession. So you can see that we're certainly in that situation right now, which makes things a little scary. And again, this is one of the best recession predictor slides I've ever seen. And all this is the unemployment rate that crosses over with the 12-month average unemployment rate. And you can see right here that every time, I'll just go back to 1980 or 84, every time that there is a cross, a recession has started. If you go back to, here we are in 2007, where the unemployment rate crossed the 12-month average unemployment rate, boom, that was a signal of the last recession. The same thing happened back here in 2000. And so this is an incredibly accurate indicator of economic recessions. Now you can see that the unemployment line has been dropping, which is good news, and the 12-month average is not too far behind it. So right now they're going in parallel, but we will see that eventually the unemployment rate will start going back up and will cross that 12-month average, and that will be a good indication that a recession is underway or is nearly happening. So obviously we are not there yet, but it's only a matter of time before the unemployment rate circles back around and crosses, and that's going to be a very, very strong indicator for a recession. So kind of going back to the markets as a whole, here's the S&P 500. And you can see here we are back on October the 7th, 2007. The S&P was at 1565, and here we are during the last recession, where we had a 57% drop from October 2007 to March the 9th, 2009. And this was that 200+ return that we had since the last recession. Now what you can see right here is that it took 6.5 years for the market to get back to even. So when you look at this chart right here, the question is, from an overall money management point of view, can you actually win by not losing? Now wait, before you answer that, did you lose some money during this last recession? Well, of course you did. We all did. So my question to you is, would you like to know some strategies to make sure that this will never happen again? Okay, I'm going to give you some examples. So again, I talked about if we were at 1565 in October 2007, it took 6.5 years to get back to the break-even point. So my question is that do you feel that we actually got back to break even after 6.5 years? Okay, that may sound like a trick question, but it's really not. If we had just 3% inflation over the last 6.5 years, that means you'd need an additional 20% in growth on top of the original amount. So let's say if you had $100,000 and you're down 57% and you got back up to $100,000, you would actually need another 20% or to have the market get up to 1880 to actually keep up with inflation. So you really weren't back to break even back in March of 2013. The market had to go up another 20% up to 1880, and that didn't happen until April of 2014. So when you actually consider the rate of inflation and the opportunity cost, let's say if you're in a fixed annuity or something that has slow growth but consistent growth, you would have been better off. Okay, so that's something that you may have to, you should consider. So another question is that is there any chance that the market may drop again? Of course there is, because we see all the sorts of volatility. And so, how are you going to make sure that you're not going to get hurt again during the next downturn? I mean, what are your choices? Okay, so there's two ways to minimize losses in your portfolio. You can use a tactical strategy that only owns the strongest positions and has a sell-side discipline that sells positions to minimize losses. Or you can buy an annuity that guarantees that you don't lose money and provides some growth. Okay, those are your two main options. So tell me, what did you learn from the last recession? Is your investment strategy the same today as it was 9 years ago? What are you going to do differently this time during the next major downturn? Okay, so the definition of insanity is to doing the same thing you did before and expect different results. So again, I have another question for you. How long do you think the market will go up before the next crash? Okay, so is it, right now, every time the market rallies, we have lower highs, and we're not being able to break this all-time high. So this is the all-time high back in May of last year. We tried to rally back here in November. It didn't get to that all-time high. We dropped again in January, and now here we are. But again, the high that we've reached so far is still below the previous high, which is below the previous high, which is below the previous high. So this is a bearish trend, my friends. And if the market can continue to go up and break this resistance here and also break the resistance at 2132, that would be very bullish. But it hasn't happened yet. And so again, I asked the question, how do you know that this is a rally that's going to have legs, or this is the beginning of a bear market? If you look at where we were back in 2007, the markets looked pretty similar. We had a nice run, and we had a big pullback, and then we came up, and you can see that was the beginning of this drop for a little over a year. So these markets are looking pretty similar. So so another question I have is that, at the time of this recording, as I just showed you on the previous slide, that we are 86 months into a bull market, which is 32 months over the average of the 54-month length of time, average time of a bull market. So again, the chances of a bear market are increasing with every month that goes by. So I'll ask you another question. if there was no cost or obligation for me to explain how to avoid losing 20 or 50% in your retirement plans and other investments, would it be worth an hour of your time to meet with me? Okay? Wouldn't it be important to know how to structure your overall portfolio so you don't have to worry about not having enough money to live the lifestyle that you want to live in retirement? So if you're already a client of mine, I'm happy to review your accounts that I don't manage to make sure that you're well positioned for this market. And if you're not a client of mine, wouldn't it make sense to get a second opinion on your portfolio? If you're currently working with another advisor and you're confident of their capabilities, then a second opinion should not be a threat to them. Okay, so it may confirm that you are on the right track. On the other hand, if you're set up to take a big fall when the market takes another drop, you need to know what you can do to protect yourself. Wouldn't you agree? So again, feel free to give me a call or stop by my office or send me an email, and just if you want to set up a call, I'm happy to talk to you about this stuff. So my contact information is on my website, jimmusgrave.com. And again, if you have any other questions, just give me a call. So until next quarter, happy investing, and we will talk to you in July.